Hello and welcome to myfinanceteacher.org. In this video, as well as in some of the following videos, I want to have a look at some of the Canadian gold mining producers, specifically for some of the viewers, Chris, that's for you, who are wondering about some interesting investment opportunities in the Canadian market specifically. Before we continue, let me remind you guys to subscribe to the channel if you haven't, and click that bell notification. Thanks a lot. So today we're going to look at Agnico Eagle, and we're going to look at gold price, the reserves of the company, production costs that they have, long-term debt, number of shares that they have outstanding, how much of those shares are held by insiders, and I think these are the main factors that are likely to affect the valuation for the company. I'm going to look at three alternatives: conservative, balanced, and optimistic view on the valuation. Starting with the conservative, remember the current gold price is around $1,495. So even if we conservatively assume that the gold price over the next few years sort of just meanders down and sort of moves somewhere around $1,400, looking at the reserves of the company of 22.6 million ounces of gold equivalent, that includes the silver, and I divide the reserves of silver by 80 because of the difference in silver versus gold price. So let's call it gold equivalent, including silver. But besides these reserves of gold and silver, Agnico Eagle actually has also copper and zinc. So these numbers do not even include their copper and zinc reserves, making this scenario a really conservative one. Besides that, the reserves don't include any of the resources, which are a little bit more uncertain in terms of how much of those actual resources might be economically produced. Looking at the production costs, all-in sustaining costs for Agnico Eagle is a little bit on the high side. It's over $900, $903 per ounce. Agnico Eagle also has a long-term debt of about $1.36 billion. They have nearly 240 million shares outstanding, and only about 0.12% of those shares is held by the insiders. These reserves are valued at the presumed gold price of $1,400. But out of those $1,400, $903 would have to be spent to extract those reserves out of the ground. That sort of gives marketable value to all of those reserves. Take away the debt, and that gives you a value per share with some secret sauce regarding the insiders, where a higher number would imply that insiders might know something good about the company that we might not. With all of these numbers, some of them assumed, some of them taken from the website, the conservative valuation comes to only around $47, with a current price of $59.83. One point to make about the reserves is all of these numbers except the reserves are recent Q3 2019 numbers. Unfortunately, I didn't find the recent numbers for reserves. These are end of 2018 reserve numbers. Coming back to the conservative valuation, we see that in a bad scenario, if gold price drops by another $95 down to $1,400, a fair value for the shares might actually be around 20% lower than the current market price. So this is basically your risk level of around 20% being very conservative. Not extremely conservative, you might say that gold price might drop even below that, but being very conservative, your risk level is around 20%. Looking at the balanced scenario, which is still somewhat conservative. This balanced scenario is not actually balanced. It's leaning a little bit. It's leaning towards the conservative scenario because, as I mentioned, current gold price is at $1,495. Whereas in this scenario, we're going to assume a gold price of $1,450. We still don't include any of the resources for this balanced scenario, and we also don't include any of the zinc or copper holdings. So we only look at the proven and probable reserves of gold and silver in gold equivalent. All the other numbers are the same, and all of these numbers combined give us a balanced valuation of around $51.77. So that is still around 13% lower than the current market price. So I would say that if you are only starting to build a core gold portfolio that you are going to hold for a relatively long time, I would say there is no shame in buying at current prices, because over the long term I think it might do well. However, if you want to try to catch a better price over the short term and maybe buy some of the shares for trading opportunity over the next few months, then you either might dip your toe with a small percentage first at current market prices, when you will probably have to average down as price goes down, or wait for a better entry price. However, over the next few weeks, if gold price doesn't dip down from 1495 to 1450, we might not see lower prices on Agnico Eagle. Now moving on to the optimistic valuation. Let's assume that in the future gold price will fluctuate somewhere around 1550, let's say, on average. Since it's an optimistic valuation, let's also include resources into the reserves. So to the previous number of reserves, including gold and silver, we're going to add only a half of measured and indicated gold resources. So we don't actually add any other resources, not even silver, copper, or zinc. So out of the resource value, if only half of that becomes economical, these would be the total holdings for Agnico Eagle, without including, remember, copper, zinc, and even some of the silver. Say production costs stay the same, relatively high. Long-term debt, let's say, stays the same. All these numbers don't change either. In that case, an optimistic valuation is going to give us $84.8 per share. That is over 41% higher than the current market price of $59.83. So over the next several months, when gold moves into the advancing phase of the next intermediate cycle and possibly breaks the recent high of 1550, we might see really nice gains on some of the miners, including Agnico Eagle. So as I mentioned in my post on YouTube yesterday, I have just started building my core long-term position in gold, starting with around 10% allocation of precious metals portfolio into GDX. I realized that over the next few weeks, GDX price might actually decline. But I think over the next few months, GDX has a good chance of at least retesting the recent highs at $30 and maybe even breaking above that. After all, central banks all over the world since the global financial crisis have printed trillions and quadrillions or whatnot of all the dollars, euros, and yen. And given that since May gold price jumped all the way from 1300 to 1500, I think the market is starting to expect inflation, and that's going to push a lot of asset prices higher, including gold. And lastly, a small bonus fact for those who has watched this video up to now. Agnico Eagle has actually recently increased their dividend, with the dividend yield now being around 1.2% per year. Of course, it's not very high, but at least it's similar to what you would get on a savings deposit in a bank. So if you were to withdraw that money and use it to buy some of the gold mining shares, at least that lost interest on the savings deposit might be compensated by this dividend yield. And that is all for now. Let me know what you guys think of gold prices into Christmas time. For now, I wish you all a happy Halloween. Remember to have a good time. Remember to hit that like button, subscribe to the channel, and of course, good luck in your trades.